on the show, I want to start by honing in on a silver update you recently released from Momentum Structural Analysis. You discussed how we recently reached a new all-time high for the S&P 500, and alongside the broad market, gold and silver are also putting in a strong performance. Now, as of today, the date of this recording, we are starting to see a correction in the broad market. I want to get to that a little bit later, but break down what you're seeing for us right now when it comes to gold, silver, and the performance of the S&P?
I think gold and silver have begun to emerge from the recent pullback. Now, silver got whacked today, but silver, we call silver the little dog on a leash, and the mama, the holding the leash, is gold. So anytime you think you see silver jumping off a cliff, it's got a leash attached to it. And if gold isn't jumping off a cliff, then silver's not. Okay, keep that in mind. And next thing you know, silver turns around to $1 off the low, that kind of thing. I think we're turning back up after the congestion. Gold got within, a couple of days ago, within $1.50 of its all-time high. And somebody said, I think I'll sell it and risk a nickel to make a dime. Okay, they did. Okay, great. But I think the major trend there remains positive. It remains no longer congestive like it was all during mid-2020 through early 2024, where gold was in this up-down range. In March of last year, we declared that process of corrective process in silver and the miners and sideways process in gold was over. We're going up. Okay. At that point, gold was just above 2,000. At a place it had been 3 or 4 times before in the prior couple of years, so no big deal, but it was to us. And sure enough, you've reached 2,800 recently. Silver at that point was $25, headed toward 26. Didn't mean much on a price chart, but within 9 months it reached 35. Right now we're either side of 31 for the last couple of weeks. I think they're continuing up. I think the main thing to propel them at this point is fracturing of the stock market. When the money flows out of that beast, as it will, it always goes somewhere else, and that place has almost always been gold if you go back through history. And I think that's likely to happen this time. So when you see the downticks in the stock market, take that as a positive background feature for gold. And if you look at the S&P, just for example, right now you're trading, probably about where you were in the peak in mid-July. Okay? So you've gone nowhere. Okay, yeah, you've been up, you've been down, but it's really not the dynamics. If you even just stand back and look at price, since the 2009 low, in the pullback into 2022, and then since 2022, it's really getting sluggish up here. And the S&P made a new high in order to get those headlines. They love it. All-time new high, Trump's elected, all this stuff. NASDAQ 100 did not. It missed it by a little bit, no big deal. But the spread relationship, which a technical feature we measure between the S&P and the NASDAQ 100, NASDAQ 100 being the leader index. Leader meaning it was the most percent gainer from 2009 to the present, and it will be the most percent loser once you go into a bear trend. This was the case back at .com, for example. Internet was going to take us off the planet. It changed the world. And in fact, it did, but the NASDAQ 100 dropped 82% between 2000 and 2002. It was the leader then, it's the leader now. The technicals we see on NASDAQ are such that the recent price lows we've seen a couple weeks back, which were just below 21,000 in the 20,700, 20,800 zone, I'm talking NASDAQ 100 now, you don't want to go back there again and close a week there. Not because of price, but because we run quarterly momentum of the NASDAQ 100 and the S&P. S&P's already fractured itself prior to the recent rally. But the NASDAQ has yet to break our key structure. And when it does, we think there will, in fact, be a sharp layered decline. It doesn't have to be a crash. Could be, but, it doesn't have to be. Instead, I think you probably should expect something more like the bear market. I think that's what it will begin. Will commence in double-digit percent slabs of decline. You get to those numbers that I just defined, you could drop another 5 in a second, because there's no more support for another 5%. When you blow that level, you could really start to go down in a more panicked way. And it's the panic factor that is not in the market. Most of the people who've been bearish based on, the norms of excess that people look at, the old textbook things, fundamental type things, they've been skeptical for some time, and yet it's not gone down. So they're really frustrated. And most of them are just now, oh, well, we need a correction. They've given up on the bear market idea. We have not. Okay. We think we have the biggest stock market bubble in U.S. history. You go back and look 1923 to 29, look at the age of the bull trend, percentage dynamics on the upside. Look at the dot-com move, mid-90s to 2000, percent gain over what span of time. And then the move from the 2002 low to the 2007 high, the real estate mortgage crisis bubble. Each of those was far less long-term in terms of years accumulated, and second, in terms of upside dimension. And you say, well, I guess the economy's been good. Well, instead, go to the St. Louis Fed site and punch up an M2 chart, money supply, and look at the rate of growth over the last 15 years compared to any other 15 years, and then especially look at the Fed funds rate chart, the rate that the Fed controls, the very short end of the market. Never have we seen, the last 10 or 15 years, free money for 10 or 15 years, effectively. There was an uptick there prior to 2000, and then they yanked it back down when COVID occurred, kept it at zero for a while, then took it back up again. Now they're cutting it again. But of the last 15 years, 10 of those have been effectively zero rates. And even with the rate rise we saw that ended a year ago, they paused and now they're starting to retreat. Even that peak was very low historically when you go back 50 years and look at interest rate levels. So there's a good causative factor of why is this particular asset category, this paper asset category, the stock market, so boosted over such a period of time. Well, it had, a drug injection in its arm, okay? Free money. And that's one of the key factors that anybody integrates into their thought process when they're making an investment commitment, a commitment to build new factories. Hey, dear, let's build a new house, buy some new property, and so forth. So all kinds of decisions, personal and corporate and government, are based on the cost of money. Well, if that was false for 10 or 15 years, then a lot of errors have been made. And so somebody who comes into office now with the idea, well, we're going to go more free market, we're not going to have government spending like it used to be. The problem is it's too late. You already have a bubble of monstrous size. And when it unleashes, you can do anything you want to do, cut rates to the bone, and it's not going to help. In fact, if you go back and look at any of the bull peaks and bear markets that followed, 29 to 32, the mid-70s to the 74 low, the dot-com peak to the 2002 low, and the 2007 peak to 2000, they cut rates all the way down, and it didn't help. It did help gold, and it did help T-bonds during that period of time, and even longer for gold. Gold went up through 2011. This time, I think, when the panic sets, we're going to see a lot of exposed errors, the kind of fundamental mistakes that corporations say, oops, we shouldn't have done that. Families say, oops, we shouldn't have done that. And those errors, when exposed, will impact data points. This is what the Fed likes to talk about. They're scientists, right? Okay. So looking at the scientific data points. Those data points are going to go dark very quickly. It's very rare when a bear market starts in stocks that the data points went south in a hard way first. They go south last. They follow the stock market. And what's the Fed going to do? Well, you want to place a bet? They're not going to be fooling around at that point. They're going to realize, we kept it too high too long. And they've got a lot of critics out there, even friends of the Fed, who've been arguing, you guys kept it up there too long. You need to cut. And they'll have the excuse to do so, not just because Donald Trump tells them they got to cut rates, but because they'll have the data points and the argument to do so. And monetary expansion, and we won't be the only ones. Because when you survey the world right now, I would say China and emerging markets are far less vulnerable than we are. Why? They're only double from where they were at the 2009 low. They're not bubbles, okay? So yeah, they could economically turn down with us. Naturally, they would. We're a world marketplace. And even Europe, you look at the Euro Stoxx 50, which is the blue chips of the Eurozone. Nowhere compared. It's only double and a half from the 2009 low. But watch India and Japan. India's up 12-fold since the 2009 low. S&P 500 has gone up 9-fold, and the Nikkei went up 6-fold.